Welcome to the deep dive. Our mission really is pretty simple. We take these big, complex financial things happening out there, things shaping your world, and we try to pull them apart bit by bit.
Yeah, give you the background, the context you need to, really get what's going on right now.
Exactly. And today,
Mhm.
today we're looking into something pretty deep. It's in the shadows of the U.S. financial system, you could say.
Right.
A powerful, uh, pretty radical tool the government has.
Mhm.
The power to just change the price of gold unilaterally.
It sounds almost theoretical, doesn't it? Like
Mhm.
something from a history book.
Hmm.
But the sources you shared, they make it clear this isn't just theory. It's being seriously discussed right now.
Driven by a crisis.
A very real financial crisis, yeah. So today we're going to unpack how this would actually work, the mechanics of it, the frankly enormous financial gain it creates on paper for the U.S.,
Right.
why they'd even consider it politically, and crucially the fallout, the global consequences, which could be huge, especially for the U.S. dollar, if Washington actually pulls this lever.
That's the core of it, isn't it? Can the biggest economy in the world use its most trusted physical asset to fix a debt problem? And what's the cost of doing that? Of basically admitting your own currency isn't quite what it used to be.
We are definitely watching financial history potentially being made here, or at least discussed.
Yeah.
Yeah. And to really get why such a radical idea is even being considered, you have to understand the context. We're not talking about your typical, 8-year up and down market cycle.
Right, the usual noise.
Exactly. This is rarer, much rarer. It's a structural thing, a financial cycle that only really comes around every, 30 to 50 years? It's like the tectonic plates of global finance are shifting, a fundamental change in trust.
Okay, 30 to 50 years. That's a big claim. So if this is such a huge historic shift, what's the evidence? What's the smoking gun data point that tells us this is happening now?
It really boils down to a fundamental change in what big players prefer to hold. For the first time in 3 decades, and the specific year being flagged is 1996 central banks around the world, collectively.
Okay.
They now hold more gold than they hold US Treasury bonds.
Wait, say that again. More gold than treasuries.
Globally.
Globally. In their reserves. This hasn't happened since 1996. It's a pivotal shift. Absolutely pivotal.
We'll just pause on that date. 1996. I mean, that feels like a different era. Post-Cold War, the US dollar was, king, unquestioned.
Right.
So to see that flip back after 30 years, that's not just market fluctuation. That's a statement, a structural change.
It is. It's a statement being made by the biggest, most sophisticated financial institutions on the planet, the central banks. What they're signaling, implicitly, is that they trust gold, this physical, non-government controlled metal, to hold its value better long-term.
Than the dollar.
Then they trust the U.S. government's ability to manage its debt and make sure the dollar keeps its purchasing power. It's a fundamental trust issue.
Okay, so that's the crisis of trust laid bare. But connect that to this gold revaluation idea. How does that distrust translate into needing such a radical kind of historical maneuver? Why can't the U.S. just, issue more bonds like it always does? Because that lack of trust isn't just abstract. It has very practical consequences. If central banks and other big lenders are selling off treasuries, or if they start demanding really high interest rates to buy new ones.
Which makes borrowing expensive.
Exactly. Prohibitively expensive, perhaps. Then the U.S. government faces a serious, immediate problem. It becomes much harder to raise the money it needs. Money for everything, spending programs, stimulating the economy, even just rolling over its existing massive debt.
So the usual well is drying up or getting too costly.
You could put it that way, yeah.
Mm.
The traditional sources of funding are becoming less reliable or too expensive. And that desperation, the struggle to finance itself normally, that's the root cause. That's why Washington is apparently looking at this extraordinary kind of dusty old tool related to its gold.
So, okay, the problem is clear. Desperation, driven by debt and this fading market confidence.
Yeah.
And that desperation makes them look inward at an asset they already have, an asset sitting on the books at a price it's, ancient history. Let's shift to that asset, the gold itself, and how it's currently valued.
Right. We need to talk about the actual physical gold, mostly stored at Fort Knox, some at the Denver Mint, West Point. The U.S. holds a lot of it, more than any other country. Officially, it's supposed to be, the bedrock.
The ultimate reserve. But when you actually look at the Treasury's balance sheet, the number next to gold, it's tiny. Almost comically small compared to, say, the national debt or the GDP.
It really is a paradox, isn't it? On the official books, all those millions of ounces of gold are valued at, get this, around $11 billion.
11 billion. With a B. In today's world, that's less than the market cap of many individual companies. It feels like a rounding error in the federal budget.
And here's the crucial historical detail. That number, that $11 billion, it's not based on what gold actually trades for today. Not even close.
So where does it come from?
It's pegged at an official price, a price that hasn't been changed since 1973, specifically $42.22 per troy ounce.
$42.22. That's incredibly specific and old. Why that number? Why 1973?
Well, it's a relic of when the old system broke down. You remember Nixon took the U.S. off the gold standard in '71, right? The Nixon shock.
Right. Ended dollar convertibility to gold.
Exactly. After that, as the world was figuring out the new purely fiat system, the U.S. government officially revalued its gold a couple of times by law. This $42.22 figure was set by the Par Value Modification Act in early 1973. It was sort of the last official peg before they completely let the dollar float freely against gold on the open market.
And they just never updated it.
Yeah.
For 50 years.
They never updated the official book value. The market price went its own way, obviously soaring way higher over time. But on the Treasury's balance sheet, still $42.22 an ounce. They essentially chose to keep this historical fiction on the books, effectively hiding the true market value of this massive asset.
So the aha moment is realizing the U.S. government officially values the one asset the world seems to be trusting more right now at a price from half a century ago. It's like a ghost of the past on their balance sheet. Okay, so if gold today is, what, over $2,000 an ounce, give or take, and the U.S. holds millions of ounces, what happens if they actually use this power? They update that price. What's the scale of the change?
The scale is, well, it's staggering. If the government were to use its authority, which it legally still has, often residing with the Treasury Secretary, to declare a new official price, say closer to the current market price, that $11 billion figure on the balance sheet, it would instantly jump to over $1 trillion.
Oh, okay. From $11 billion to over $1 trillion.
Just by changing the accounting.
Just by updating the price per ounce on the ledger to reflect reality. It's an instant capital gain, purely through an accounting declaration.
$1 trillion gain. Disappears.
And think about how that connects immediately to the government's biggest headache right now. The budget deficit.
Which is huge.
Massive. Recently running near $2 trillion annually. So the immediate headline benefit of doing this, revaluing the gold could instantly cut that perceived deficit roughly in half, from $2 trillion down towards $1 trillion. Hold on, though. That sounds a bit like magic money. Wouldn't the market see right through that? If you're already worried about U.S. finances, wouldn't they just say, okay, you fiddled the books, but nothing actually changed? Isn't it just an accounting trick?
That's a really important question. And yes, fundamentally, it is an accounting trick. But it's an accounting trick with potentially huge psychological and practical implications, especially for how solvency is perceived.
How so?
Well, the mechanics matter. The Treasury wouldn't just book this as, like, income tax revenue, that $1 trillion difference, the capital gain from revaluation. It typically gets credited to a special account. Often it's the Exchange Stabilization Fund, the ESF.
The ESF. The Treasury's kind of slush fund. Used for managing currency markets and gold stuff.
That's a way to put it, So by putting a $1 trillion capital gain there, it increases the government's net worth on paper. They don't suddenly have $1 trillion in cash to spend, not directly. But it dramatically changes the optics of their debt situation. It instantly improves key metrics, like the debt-to-GDP ratio. It signals to the market, hey, look, our balance sheet is stronger than you thought. It gives policymakers enormous breathing room politically and psychologically.
So it lets them borrow more, or makes existing debt look less worrying.
Both, potentially. It makes hitting self-imposed debt ceilings less immediate. It might reassure markets that there's more backing the nation's finances than previously shown. It's like they're revealing a hidden strength, leveraging the deep trusted value of gold to reset the perception of their overall financial health.
So it's using a 50-year-old accounting anomaly to create a shield against today's market skepticism about debt.
Exactly. Leveraging history to manage a modern crisis. And in doing that, they gain political capital. They look more solvent without needing painful spending cuts or unpopular tax hikes right away.
But as you said, they don't just need better optics. They need actual money, fresh capital to spend, to stimulate the economy.
Right. And that brings us to the second part of this potential strategy. The revaluation cleans up the balance sheet, but it doesn't directly provide cash.
And we already established that just issuing more regular Treasury bonds is getting tricky. Because The buyers, the central banks, are hesitant about the dollar itself.
Precisely. So if they just try to flood the market with more standard dollar-based debt after this revaluation, those same skeptical buyers might still balk, or they'll demand those high interest rates we talked about.
Which kind of defeats the purpose.
It does. So this leads to the more creator part mentioned in the sources. Instead of traditional bonds, the U.S. government could issue something new, U.S. gold receipts.
Gold receipts. Okay, tell me about those. How are they different?
Think of it as a direct response to that 1996 data point we discussed. The government is basically saying, okay, we get it. You're wary of holding more pure dollar debt right now, but we know you do trust gold. So these receipts would be issued against those newly revalued gold reserves, that $1 trillion of recognized asset value. This allows the government to borrow fresh money from those same skeptical lenders, central banks, big private funds, by offering them debt that's explicitly linked to or backed by physical gold.
So it's like collateralized borrowing, using the gold as collateral.
Essentially, yes. It's offering lenders exposure to the very asset they've already shown they prefer, gold.
Okay, let's break that down. A normal treasury bond versus a gold receipt. Why would a central bank prefer the receipt?
A standard treasury bond is basically an IOU from the U.S. government. It's unsecured debt. Its value depends entirely on the government's promise to pay back dollars plus interest.
And the future value of those dollars.
Crucially, yes. If you, as a lender, think the dollar is going to lose value, be inflated away, then even a high interest rate might not be appealing. Your real return could be negative.
Because the dollars you get back buy less stuff.
Yeah.
Makes sense.
Right. But a gold receipt fundamentally changes the risk calculation. While it might still pay interest in dollars, its ultimate value is tied directly to the physical gold held by the Treasury.
So if the worst happens, like a default or hyperinflation of the dollar.
The idea is that the receipt holder would have a stronger claim, either a claim on a portion of the physical gold itself, or at least a claim on its market value in dollars at that time. It acts as a built-in hedge against the dollar losing value.
So it anchors the debt to a commodity, not just a promise in a potentially weakening currency.
Exactly. It gives lenders an interest in the asset gold that they already trust while simultaneously giving the U.S. government the cash it needs. It bypasses the trust issue with the dollar by leaning on the trust in gold.
What kind of maturity would these have? Short-term, long-term?
Given the likely need for immediate funds, they might structure them as, say, medium-term notes, maybe 5-10 years. But the key selling point isn't the duration, it's the collateral. It's asset-backed debt on a sovereign scale.
Using the one asset they have that still commands almost universal international trust.
It's a very pragmatic, maybe even cynical response to the market signals. They're leveraging that trust in gold to work around the lack of trust in their traditional dollar debt.
It sounds like a clever financial end run, using an old idea asset-backed securities, basically to solve a very modern crisis of confidence, all to get the cash they need for economic revival without relying on the old bond market that's getting hesitant.
That's the strategic goal, yes. If the world won't readily lend you dollars based on your promise alone, you offer them something backed by gold. The deep irony, of course, which we need to get into next, is that this very clever move, while potentially solving a short-term funding problem, is also a massive flashing signal about the dollar's own long-term issues.
Right. That's the trade-off, the big but. Let's move into that now. Section 3, the slippery slope and the devaluation risk. Because this whole maneuver, it's definitely not a free lunch.
No, far from it.
Okay, so we've got the upside. Deficit looks better on paper. Government gets cash via gold receipts. But you're saying there's a huge downside, a self-inflicted wound almost, to the dollar itself.
The irony is just unavoidable. Think about it. The U.S. government, the issuer of the world's reserve currency, the main proponent of the modern fiat system, if they feel forced to use physical gold as collateral because their own dollar-denominated debt isn't trusted enough, what message does that send to the rest of the world? It's a catastrophic signal.
It's like Washington itself is saying, yeah, you guys have been buying gold since '96. You were right all along.
Exactly that. The action validates the very fears that drove central banks towards gold in the first place. It immediately boosts global confidence in gold as the ultimate safe haven, the reliable store of value independent of government policies.
And the flip side of boosting gold
is that it inherently devalues the U.S. dollar, or rather, it accelerates the dollar's decline relative to gold and potentially other currencies.
Why more so than, say, just printing more money through QE? Doesn't that also devalue the dollar?
It does, but this is different. QE is monetary policy, often framed as temporary or technical. Revaluing gold and using it as collateral is a fundamental statement about trust. It's the issuer admitting the market's confidence in their primary product, the dollar is shaky.
It confirms the narrative.
Precisely. It confirms the central bank's thesis. Gold holds value better, it's more trustworthy than the dollar in the long run. Every other country, every major investor sees this and thinks, well, if the US Treasury itself needs gold backing to borrow effectively, why should we hold unbacked dollars?
And that feeds on itself. The move is born from desperation about dollar trust, but the move itself further erodes that trust, driving more money globally into gold, pushing the dollar down further.
It's a potential feedback loop. You solve an immediate budget optics problem and a funding problem, but you arguably worsen the long-term currency credibility problem.
Now, you're saying this isn't just us speculating, that big market players are already thinking along these lines.
Oh, absolutely. This potential outcome, or at least the underlying pressure forcing such thinking, is already being factored in by major financial institutions. They're positioning themselves, advising their clients, based on the assumption that this structural shift away from dollar reliance is real and ongoing.
Okay, let's look at those specifics. What are the big banks like Goldman Sachs or JP Morgan actually predicting for gold prices? That tells us what they really think.
Their forecasts definitely suggest they see this as more than just a temporary blip. They're anticipating continued, strong demand for gold, driven by these very issues of debt, deficits, and waning confidence in fiat currencies, particularly the dollar.
So give us the numbers. What's Goldman saying?
Well, Goldman Sachs, according to the sources, has put out a forecast expecting gold prices to rise significantly by around 22% over the next 12 to 15 months.
22%.
Yeah.
That's a very strong call. That's not just keeping pace with inflation.
No, it's a major upward move. It suggests their models are seeing sustained flows into gold, likely as a hedge against exactly the kind of systemic risks and currency debasement fears we've been discussing. They clearly believe the factors pushing investors towards gold aren't going away soon.
It implies they see the pressure on the U.S. financial system continuing, maybe even forcing moves like the gold revaluation, whether officially planned or not.
It certainly reflects a belief that the environment is becoming much more favorable for gold as a core holding.
Okay, what about JP Morgan? Sometimes seen as a bit more, maybe conservative or shorter-term focused.
Even JP Morgan is projecting further gains. Their expectation, reportedly, is for gold prices to rise by over 6% in just the next 9 months.
6% in 9 months. Okay, smaller than Goldman's number, but still clearly pointing upwards.
Right. And coming from JPM, it signals a broad consensus, really. They're not calling for a pullback. They see continued appreciation, likely driven by that same global demand for a reliable hedge in an uncertain financial world.
So both are essentially betting that this trend, the one highlighted by that 1996 central bank data, the preference for gold over treasuries, is the new normal, and that governments, especially the U.S., might have to react in ways that further validate gold.
The smart money seems to believe this isn't just cyclical noise. They see that longer 30 to 50-year cycle, the gradual erosion of the dollar's unchallenged dominance is being firmly underway. If the U.S. were to revalue its gold or issue gold receipts, that action wouldn't necessarily cause the gold price rise, but it would be a massive official confirmation of the trend. It would be the U.S. Treasury basically admitting, yes, the central bank's moving into gold, we're onto something.
And the ripples go everywhere. Trade deals, reserve holdings, even just your savings. If the anchor currency's own issuer signals weakness, that impacts everything.
Everything denominated in dollars, everything benchmarked against it. The perceived safety floor under the dollar gets significantly lower, weakened by the actions of its own guarantor.
It's a fascinating high-stakes dilemma. Solve the immediate $1–2 trillion budget hole,
but potentially cement a much larger, longer-term problem regarding the dollar's global standing and value, a problem that could ultimately cost far more in lost purchasing power and international influence.
Okay, that's a lot to absorb. Let's try and pull the key threads together for everyone listening. A final summary.
Sounds good.
All right, as we wrap up this deep dive into the ghost of the gold standard, really, we've looked at a pretty radical option born from a crisis of confidence. Let's recap the main points for you.
Okay, point 1. The trigger for all this is that big shift we talked about, central banks globally now holding more gold than US Treasuries. That hasn't happened since 1996, and it signals a deep structural erosion of trust in the dollar's long-term stability.
Point two, the U.S. government actually can, legally, just declare a new higher value for its gold.
Mm.
It could turn that $11 billion book value,
Yeah.
based on a 1973 price, into potentially over $1 trillion almost overnight.
Mm-hmm.
And doing that would instantly make the current $2 trillion budget deficit look half as bad, providing, significant political and financial cover.
Then point three. To get actual cash, not just better accounting, the Treasury could issue new debt instruments, these U.S. gold receipts. They'd be backed by that revalued gold, making them more attractive than regular bonds to nervous central banks. It's a way to keep borrowing when trust in the dollar itself is low.
And finally, point four, the big catch. The unavoidable cost of playing the gold card like this is that it hammers the dollar's credibility. It essentially validates global fears about the dollar's future, likely accelerating its decline relative to gold and maybe other assets or currencies. It confirms we're in one of those rare 30 to 50-year shifts in the global financial order.
A shift historians will be dissecting for a long, long time.
Absolutely. Which leads us perfectly into our final thought for you, the listener, to maybe chew on.
Yeah, think about this. If the world's dominant economy, the issuer of the reserve currency, finds itself in a position where it seriously considers using an accounting rule from 1973, a leftover from a monetary system that died half a century ago, just to manage its current budget problems, what does that really tell us about the inherent stability, the long-term resilience of the entire fiat currency system we've built since then? They're potentially using a historical accounting quirk rooted in gold, to patch a hole in a system supposedly free from gold.
It feels like a contradiction.
It really does. And if this one-time fix gets used now, what's left in the toolkit when the deficits inevitably grow again? What happens when global confidence in the dollar, already shaky, takes another hit? Is this move just kicking a much larger can down the road? Could it be a sign that the foundations of our modern monetary system are perhaps not as solid as we've assumed?
A sobering question indeed. Something to definitely keep thinking about. Thank you for joining us for this deep dive.
Thanks for listening.
We'll see you next time.